Welcome back to Fast Market on Schwab Network. I'm Diane King Hall alongside Tom White. Time now for our cash tag segment. For that, I want to bring our next guest in. We've got Megan Brantley, Vice President of Research over at Likefolio. Megan, happy Friday. Thank you so much for joining us today. All right, you've got fresh data on Netflix. Just to give folks context, the stock is up more than 8% year to date, so beating the S&P 500. What does your data show you about how Netflix is as it stands now?
Yeah, whenever we look at Netflix, I think if you zoom out over the last year and a half, the two largest growth drivers in our data have been the introduction of its ad tier and also its foray into live sports. And you can see that whenever we look specifically at web traffic for Netflix, we saw a massive increase in the month of November, and then also a nice little bump in December whenever Netflix hosted the Jake Paul-Mike Tyson fight and also the NFL Christmas Day matchup. And so I think that this has proven that live sports not only grabs these consumer eyeballs, but it's also very compelling for advertisers. Recently, Netflix announced that it also secured rights for the FIFA Women's World Cup coming up. So I think that this is a smart move, and this is what's been driving a lot of the growth that we've seen in Netflix, at least in terms of consumer interest. But we do want to watch for retention long term, because we have some signs in our data that a lot of those consumers that Netflix gained may have jumped on to watch those sports events and they popped off. And so I think that this is something that investors will be watching pretty closely, just because Netflix was able to report such nice user growth last quarter. And this chart that you're looking at right here, this is those searches for Netflix with ads. And I think that this is really important because around 40% of Netflix's new signups in areas where ad tier is available is coming from this ad tier. And so this is an important area to watch for sustained growth. We certainly are seeing this sustained growth, and we'd like to see this sustained growth alongside more of these live sports opportunities, because we think this is where Netflix can really max out its ad potential.
Megan, do you have any insight on, one of the things that we've heard come up is with regard to the streamers is subscription fatigue. Do you have any insight on that as it relates to Netflix or the industry in general?
Yeah, whenever you look at Netflix and you compare some of those premium price points versus other price points, I think Netflix sits probably at the highest. I think its premium tier is around $25 a month if you're getting that without ads. But one of the smart things that Netflix has done is, if that is too much for consumers, there are lower price models that they can trade down to. And I think that this is really smart. This is something that a couple of years ago, Netflix didn't have the option to say, okay, you don't want to pay $25 for this premium subscription without ads. You can pay $8 a month and you have to watch a few ads. And so I think that this has really boosted those retention numbers. When we look at cancellation and churn, we don't see it at such a large scale. We see it more reactionary for those users that may have been jumping on just to watch a sports event that they were wanting to see. But at large, I think that this is really important that Netflix has multiple price points. And for us, we think it's smart because not only can Netflix now monetize its premium customers better who are willing to pay more without those ads, but it gives a solution for those customers that it may have lost in prior years because they're able to trade down to this much more affordable ad tier.
Hey, Megan, question for you, because now that new bundle between Disney Plus and Warner Brothers Discovery, I think it's $29 for 3 platforms, including Disney Plus, Hulu, and Max. At this point, that's about $29. The premium for at Netflix is nearly $25. So retention rates, according to Antenna data, their retention rate's 80%. Netflix is down to 74%. So competition's coming into this space at this point. But Megan, does it still rely for Netflix, that earnings beat as far as net ads last quarter was 18 million, about double what they expected. Is it still going to be live sports because they've got the WWE connection now with TKO, but at the same time, moving forward, it's going to be more about, live sports because that gave them that big boost last quarter, right?
Yeah, for us, we see live sports as this not only a catalyst in attracting those viewer eyeballs and those subscriptions, but also in maxing out those ad dollars, because you have a consumer who is actively engaged and more likely to be paying attention to an ad versus when they're casually viewing maybe, just on a Friday night. And so this for us, I think, is essential moving forward. And it's smart that Netflix is pivoting and turning into these live sports. But I do think that that's also the cause of that bit of a pullback in retention that you mentioned. Typically, Netflix's retention rate was higher, but this was whenever it was counting on users who weren't being driven by these live sporting events. So a little bit of a catch-22 here with Netflix, but we do think that live sports is the ultimate driver for growth when it comes to new consumer eyeballs and also the increase in ad dollars, what it's able to command from advertisers. And that's what we'll be watching moving forward to see if it continue to attain these surprises in user growth like we saw last quarter.
And then, Megan, I want to ask you, in terms of that increase you in your chart showing that 10% increase in web visits, does that translate typically into a meaningful increase in terms of company performance from how your data shows?
Yeah, for us, a lot of times this is an indication of new signups. So the reason that you would go to Netflix, especially online or on a desktop or something like that, versus an app or on your computer, is to manage your subscription. And so a lot of times whenever we see an increase in that web traffic, that's an indication of a user who's going on to sign up for a plan. We do listen for mentions to try to understand what churn rates might look like, because this could also be an indication of a consumer canceling. We don't necessarily see high churn. We don't see signs of consumers en masse saying they're canceling. We actually see a rise in consumers who are just exploring the different plans, and a lot of them signing on for that ad tier. So I think that the look in advertising and Netflix continuing to provide value to those advertisers and connecting them to consumers that are interested in those brands is essentially moving forward and largely a growth driver.
And Megan, any final takeaways that you want to leave us with from the most recent Likefolio data on Netflix?
I would say that our data right now for Netflix looks pretty positive. We still think that the brand has a lot of pricing power. This is still a best-of-breed name in our opinion, but competition is certainly relevant. We think that as consumers, experience that subscription fatigue right now, we don't think Netflix, with the variety of entry points in terms of subscription values, is high on the chopping block.
Okay, so the diverse entry points still make it pretty attractive. Megan Brantley, Vice President of Research over at Likefolio, thanks a ton for your latest data on Netflix.